Hello everyone, I'm Shekhar from Momentum Lab. Today we have a very insightful video. I have Abhijit from InvestingFool, and Abhijit has been building his Momentum portfolio in public since December 2023, and he has had a great run so far. And we'd like to get his insights on DIY investing and what prompted him in this journey. And by the way, Abhijit is an MBA grad from SP Jain, and as well as he did an undergrad from NIT Roorkela. Abhijit, over to you. Can you please brief us about your education background and your professional experience?
Hello everyone. Thanks, Shekhar, for having me on Momentum Lab. Yeah, as far as my educational background goes, I graduated in engineering. I graduated in 2015. Then I worked with Core India for 2.5 years. Quit that job, went for an MBA in 2018. Finished that. Worked with Amazon for 2.5 years. Felt like I wasn't getting a real kick in what I was doing. So I quit Amazon around the end of 2022 and moved into product and UX design. Still discovering myself here, and I keep working on other projects as well. So uh, it's been a journey. I'm really not sure what I'll be doing 3 or 5 years from here. So not a stickiness, not a lot of stickiness there. So yeah, that's been my journey.
Great. I think Abhijit, you and I have common in product management. I think you're a product designer, right?
Yeah. I dabble into a fair bit of product management also at times, but yeah, mostly it's in design. Yeah.
Great to know that. Cool. Abhijit, I would like to know your journey. I know momentum investing is the current forte that you are into, but what was it back then when you started to invest, and when did you start your investment journey?
Got it. Yeah. So back in the day, it was I would say all over the place. I My journey has been just like any regular Joe in the Indian stock market, going from place to place, trying different things until you find what works for you, and that has been momentum for some time for me. But let me go back to when it started, how it started, right? So right when I got my first stipend during my undergrad, I like thought of what could be an additional usage of this money apart from the spending, right? So what would be an optimal usage for this money? I was interested in investing from that time itself. So I think in 2015 or 16, I don't remember exactly, maybe 15. I started my first brokerage account, and I started investing in stocks directly also, as well as I started getting some exposure into mutual funds also. In the initial couple of years, it was mostly mutual funds and a little bit of direct investing. And within direct investing, as I said, it was all over the place. In fact, within mutual funds also, it was all over the place. So like I would go with like whatever typical investors do, right? Look at the last 3 years, 5 years returns, which funds are performing well. You kind of go with them. You do not have any inkling of how they're going to perform in the future, right? And there was no conception of even passive investing at that point of time. So I started with direct mutual funds, and equity was very discretionary, completely discretionary. Whatever story motivated me, wherever I came across a stock, I was reading a lot of books. I was trying to get thorough in fundamental and value investing. So I started with those, but yeah, in the initial years, it was like all over the place, and that was the beginning of my investment journey.
You started from value and moved to momentum.
Yes, there's a fair bit of like things happening between that also. So like in the initial phase, I was very much drawn to fundamental and value investing, as many of the
Right.
investors that we come across are,
Right.
right. So I was firmly kind of in that camp, and I was reading these books Intelligent Investor was there, then Peter Lynch's One Upon Wall Street was there, then many of the little book series from Willie was there. I was following a few blogs as well. Even attempted to read Ashwin Damodaran's book on valuation. I never got around to fully like understanding all of those things. And even when I practiced, right, I would make some bets, but I never got the full conviction. And why it was is the first thing was that valuation always seemed a bit subjective to me. There were so many assumptions
Right.
that were kind of linked to the personality of whoever is doing that valuation. Right, I could give you the same metrics, and 20 different investors could come up with 20 different valuations for the same company.
Correct.
Right, and even when I made money on the stock, right, I was never fully sure whether it was due to my analysis, whatever I was doing, or it was just luck. Right, the monkey dart, the usual monkey dart problem. Right, a monkey throwing darts can probably beat most fund managers. Right, and I also lost some bit of money on stocks where I had some conviction that I was going full in. My analysis is great and all. And I got a learning that never consider your analysis as better than the market. Market might be knowing something that you are missing out, right? So never be so confident on your thing. And averaging down was one of my familiar mistakes. So whenever stocks went down, I always, because my mentality was always like that okay, I'm getting the same
First time
thing
ever trying.
for cheap, right? So
Right.
yeah, you just buy more of it. What's the problem in that? The problem is it's never the same thing, right? If the price has changed so much, it's mostly it's not the same thing, right?
Correct.
And yeah, averaging down was one of my biggest mistakes at that point of time. So during this phase, I realized three things about myself. First was that taking subjective calls, I was not good at them. I was not good at discretionary investing at all. I tend to get biased. My biases come into play. My confirmation bias, my anchoring bias, all those biases that we talk about, everything
Right.
comes into play when I get into investing. The third thing was that I couldn't stick around with huge losses for long periods of time. I like, no matter how good a story, no matter how good a stock, a company, a management, whatever is, if like I'm sticking around with like 50% loss, 40% loss, I can't sit around 1 year waiting for the stock to recover, right? There's a huge opportunity cost there. So then after this, like this entire dabbling into value investing and everything, trying it out, not working out, there was a phase in which I went almost fully into index investing, right?
Oh,
And there was this conversations about why people are paying more for regular mutual funds versus direct mutual funds, and there was a parallel conversation about why people are paying more of an expense ratio to active managers when most active managers are actually underperforming the index.
right.
I went through a lot of SPIVA reports on how much the underperformance is. I went through books like The Little Book of Common Sense Investing by John Bogle. And I kind of convinced myself, because I was convinced anyway, that discretionary stock picking is not working out for me. It's certainly not working out for me. And I was not even maintaining a trading journal, right? I
Okay.
had no way of knowing whether I'm even like I knew that I'm definitely underperforming the market, but by how much I'm underperforming and what all this discretionary calls are leading to, I was not documenting all of that, right? And I thought that okay, I'll just stick with index investing, ETFs. So I stuck to that for a while, and then
Which was the ETF that
then
you, which was the ETF that you are regularly purchasing?
mostly into Nifty 50 and Nifty Junior.
Okay.
I never went into any sectoral ETFs, but yeah. That's probably it. Like I think I owned ITBs at some
Okay.
point of time, but yeah, but mostly into the regular mutual funds,
Clear.
and then from like I gradually got exposure into systematic investing in terms of like factor investing, quant, momentum, all of that came after that
When
much.
did this happen? In which year?
I guess around 2020 only.
During
Around
COVID crash
2020,
or post or pre-COVID?
post COVID crash. Post
Okay.
COVID crash. Yeah.
Were you inspired
So
by any of these influencers who were running momentum back then?
in within momentum, I would say I was definitely like inspired by Alok Jain for
Hmm.
sure, because he has a way of, he has a very like calming maturity
Right.
about as well, and he has a way of putting things in context. So yeah, that got me at least start like to start thinking about okay, like this is a very radically different way from what I am thinking, right, or how I am used to thinking. So we are used to some sort of mental conditioning
Hmm.
that when we are shown something completely different, first we go into like a state of shock, and then
Right.
we start thinking, okay, can it be like that? And then when we start questioning, we start unlearning a lot of things. We start to kill a lot of assumptions, right? And that's when, yeah, your kind of eyes are opened, and you get.
I think Alok Jain has successfully not brainwashed, but conditioned a lot of the people's minds that momentum investing is a good thing to do. And by the way, did you invest in any of
Yes.
his small cases back then?
No, I didn't invest in any of these
And how
of
did
his
the
small
journey
cases.
start of
So
investing in
journey started by,
momentum?
so I started reading on like a momentum system. So like I just did a little bit of momentum, like maybe in 21, but mostly it started like after 22. Okay.
Got it.
So in around 22. So even at that point, I read the basic premise, right? So when you first get exposed to something like momentum, I didn't even know. I knew momentum investing first and then factor investing, right? The
Oh, yeah.
ideal sequence
Yes.
is for someone to know what is factor investing first and then
Right.
delve into the individual factors.
Right.
But whatever. When I started reading about it, most of the academic papers that I came across, they use like 12 minus 1
Right.
months ROC for comparison purposes, right? And even with that, and this I read almost like everywhere, even with a very very simplistic system, you are highly likely to beat the index over the long term, right? Why that works, and even the economist, I'm not sure if I should call him an economist, Professor Eugene Fama, who gave
Mhm.
efficient market hypothesis, right? Even like when you come to know that even he described momentum as an anomaly,
Big
right?
anomaly. Yeah.
And that was not explainable. So when you go back into research, you kind of go into a rabbit hole. You see that, okay, this is a phenomenon that exists. It has been observed for like Indian market obviously has very very less data, but you go to mature markets, you see like over decades it has been observed. It's something that is very very persistent across asset classes,
Right.
across geographies,
Right.
right, across markets. So there is definitely something, and so I started basically by just doing my own calculations of like ranking stocks from like any universe, and like looking at the last 1 year returns, right, and
Okay.
just buying into some of the stocks. But even at this point, even when I was starting at momentum, uh, like I knew that obviously it's a portfolio construct, but when I started constructing it, I would still like let some biases creep in, right? If I got 20 companies, I'm reasonably okay with buying 15 of those. I'm not that much okay with buying 5 of those. And why that is, because I have some preconceived
Right.
notion that yeah, something is not right. The stock, maybe the chart looks manipulated. Maybe like some quality would be giving some voice in my head that, okay, the debt to equity, look at the debt to equity, it's so high, right? Why would you get into it? So even after doing all that, I would try to eliminate some stocks based on red flags.
Okay.
And yeah, I didn't feel it added much value. So at that point also it was a little bit discretionary, and gradually I like shed all of those things, and I kind of tried to go fully systematic. I like basically that's what, right, that's why my channel's name is also like Investing Fool. I started it when I started it, it started with a an idea of publicly journaling my momentum investment journey. So it's a fairly conservative portfolio, I would say, although nothing is momentum is really conservative. But within Nifty 500, we are picking the stocks, and we are tracking it, right? So we're tracking it for almost like 9 months now. And the starting point was that there is so much of content around on YouTube. People are so stock specific. Everyone talks about some stocks and then goes away. There is never any follow up, right? So I wanted to have like publicly communicate whenever I'm entering anything, whenever I'm exiting anything, why I'm entering, why I'm exiting, basically making a fool out of myself. Because sometimes I just enter stocks which are like in very very high momentum, they fall 30%, I exit 30%, and then like you would get comments like this is so foolish, like why would you get at that top, right? We only know those things in hindsight, but
Right.
when you put it out there, it kind of brings a rhythm to my own investing as well.
Right.
So yeah, so that's how I got into systematic momentum investing.
Great, great, Abhijit. I think I can echo all your sentiments. And if you may give us the strategy, like maybe the universe, the number of holdings, rebalancing, a little bit of color of how do you approach this momentum investing?
Got it. So currently, we've built upon a very very simple system. So the part about momentum that most people need to understand is that momentum broadly works. Okay, that's the first thing that you have to keep in mind. A lot of the very very like small adjustments that you do, maybe they would have some impact, but the broad construct is like whatever is winning, like keep winning stocks in your portfolio and gradually phase out of losing stocks in your portfolio, right? About the specifics of the core portfolio that we track on Investing Pool, it's it's based on the stock selection universe of Nifty 500, right? So from the 500 stocks, we pick 20 top ranked stocks in terms of momentum. Now, what do I mean when I say momentum? So momentum can be there could be so many indicators to track momentum, right? A simple one, as we just discussed, is the rate of change, which is how much return a stock has given in the last year, right? What we do is to account for volatility, we take the Sharpe ratio or Sharpe return rather than the absolute return, right? So, this I discussed in one of my recent videos as well. If there are two stocks, right, one is just going like, let's say the curve is like a fixed deposit, it's completely linear, while the other is going all over the place, right? But the starting point and the end point are the same, right? So if you just absolute return, then it doesn't account for all the heart attacks this stock will give you along the way, right? So to kind of smoothen, and there are many other parameters also you can take, like the percentage of positive days in the last X period also, though many kind of metrics exist. For my system, we take the average Sharpe return across 4 look back periods, so 3 months, 6 months, 9 months, 12 months. We combine them into one consolidated like a rank, and we pick the top 20 stocks from that ranking. Now, when you do the rebalancing, so rebalancing I currently do bi-weekly. I used to do it monthly. I may even transition to monthly again. Like there is no real advantage also, that much advantage, but I personally I feel like that's a sweet spot, because many of the exit criteria that I have. So let's talk about the exit criteria, right? So when a stock starts losing momentum, right, you cannot have it get kicked out of the portfolio with a very very small deviation from its path, right? So you need some leg room there. So there's this concept called the worst rank held, which is basically allowing for some buffer, some leg room for the stock to consolidate, to sometimes take a breather, and then to again regain momentum. If there's a long-term momentum trend, it will anyway stay intact, right? So for me, that is 50. So what it means is that a stock may not be in the top 20. And by the way, I check this only on the rebalancing day, right? So if there is no rebalancing day, just go take a walk. Don't do anything, right? It's better if most investors don't even look at their portfolio. Why we such an itch to do something, to sell some units of it, so buy some units of something else, is because we keep looking at our portfolio too often, right? If from your investment journey is going to be probably many decades, right? People are investing into their 90s also, so you have to think it like that. So in that time frame, none of this tinkering would kind of matter, right? So I look at it only on the rebalancing day. If on the rebalancing day the stock is within the top 50 ranks and it is part of my portfolio, then it stays in the portfolio. If anything drops beyond rank 50, then I kick that out of the portfolio. The other condition, which is kind of, and there are some filters I use, which you can see on my video as well. For example, it should be within 25% from the all-time high. So these filters, they also come into effect during the rebalancing. So if something has fallen by more than 25% on a rebalancing day, then I would exit that day, that stock. But I would not be checking this each and every day. That I would not be, because there are a lot of whipsaws. If you keep exiting at every small thing, then you would not be able to differentiate between what is a signal and what is a noise, right? So some sanity has to be there.
Great, great.
So this is broadly the system. And in terms of one more thing is that like drawdowns and all. So that is probably one thing where I'm still exploring and learning. But yeah, this is broadly the system.
Got it. And where do you track these investment journeys that you make? Do you maintain a Google Sheet, or is there any software that you track?
Yeah, I use Google Sheets to track this, and the same is the same thing I share on my YouTube videos as well. For screening, I use the Momo India Screener, which is a paid portal. I've been using it for some time. I also am testing a Python script of my own, but haven't fully transitioned as of now.
Got it, Abhijit. And during your journey in building public, there might have been certain instances where you might have underperformed the index. And when you underperform, especially when you're building it in public, there will be a lot of internal turmoil ki aaj video karna hai kya, we are now underperforming. So how do you take that emotional turmoil and move on?
Yes, good question. So there is no way to escape it, kind of. At least you're building it if you're building it publicly. And fair bit of criticism always happens when people realize that even after doing so much, right, they are underperforming the index. And when I started, when I started, I think in the first few months also I was always kind of underperforming
Okay.
the index, right?
Okay.
And you have to remember that something works in the long term doesn't mean that it works in the very immediate term as well, right? There is a huge thing called starting point bias. So you see all these backtests that are there, and every backtest will be from time A to time B. But what is the probability that you will go and start investing at time A, right? That's not really possible. So when you like start looking at maybe rolling returns, or you look at median rolling returns, then you probably get a better sense of where things are going. And that is the thing that should keep you grounded, that okay, I am underperforming, be open about it, that yes, we are underperforming, but this is an experiment, right? This is an experiment that I'm doing with my own finances and on public as well. So if I keep underperforming for like multiple years and through market cycles, because sometimes in secular bull trends also you do not know many of these indices, because I get this question also fairly, and in the initial part I was not beating even Nifty 500, right? So gradually I started beating Nifty 500, but even now I said now pre-tax, like there is like a 10% or 9% alpha from Nifty 500 to my returns. But even now, I can very confidently say that with one major crash or anything, I will go under it for sure. Right? To never take comfort in whatever alpha you have achieved in this kind of a bull market when the Nifty has given 30% in like less than 1 year, right? So it's so that is always a reality. You should always evaluate it over market cycles. Never conclude anything based on any data less than 1 year.
Yeah.
At least 3 years, more than 3 years. Even 3 years is not like, market cycles do not change like that just in 3 years, right? 3 years is also a very short period.
Right.
So ideally longer than that. And one point that I was mentioning is that even in secular bull trends like this, right, momentum indices, NSE created momentum indices, which have been performing handsomely, right? I have been underperforming that. I'm open to admit that, but they rebalance like every 6 months, right? Personally, one of the reasons why I do DIY, why I continue to do DIY is because I like the flexibility of cash calls, which they do not take. I like the flexibility of a shorter rebalancing period, right? And I like the possibility of expanding into larger universes in the future. That's also there. And so when the market is not in a secular bull run anymore, when it starts going sideways or not, we will see some impact of having a 1 month, because a 1 month rebalancing in theory, as per research, should accord better returns or should have better performance than a 6 month. Otherwise, there is no reason for someone to go even beyond that, right? Do a 1 year rebalancing, right? But but somewhere that rebalancing period starts to have an impact, and somewhere that impact dissipates again, right? If
Right.
you're doing your rebalancing daily, it won't give you that much of an additional advantage. So you have to define that sweet spot. And yeah, but yeah, how emotionally, how do coming back to that question on how I prepare myself for these videos. Sometimes I don't. I would be fair. Like if it's like if everything is just fully in mayhem, maybe on 4th of I think on 4th I didn't make a video on June 4th after the election
Election
battle.
results,
I
yes.
didn't make a video then. Yeah, because I was still like everything was falling. Okay, everyone is losing money. I think I created a post whenever I'm not able to make videos. And why I was not able to make videos, because there was no clarity. Okay, how will the markets react tomorrow? Like if I make something today based on whatever yarn I'm trying to give, and tomorrow it's a completely different picture, right? So we never know. So I waited, and I guess it was on a Wednesday or something. So I waited a couple of days or 3 days, and made it on that Friday or something. So sometimes it's because there is so much happening that you do not have a complete picture. So you want to get some things, you get to have some understanding of where things are going before you make a video. And whenever that happens, I typically create a post on my YouTube channel as well, so that members can get some inkling of what my thoughts are on the current thing, or I would do a poll or something like that.
It is always
And
good
that
to take a
Yeah,
pause before we react quickly. Once
yeah,
we take a pause,
yeah, yeah.
we can collate our thoughts and be more balanced.
Yes, and in investing as well. I'm sure many people would have just sold many of the stocks in their portfolio
Yeah,
right away on the report. Yeah,
right, right.
irrespective of where we are now, if you just look at that run, what kind of runs a bull markets can do, right? From June 4, what happened
Yeah,
till the beginning of July, people would not have expected it, right?
yes.
Because nothing materially changed in the information that they were getting, but still the markets thought of something different, right? So you never know. So never try to second guess things, and never try to be very impulsive about buying, selling, and everything. Just
Follow the
let
rules.
it be. Close the screener and walk off. Yeah.
And are you planning to create some new strategies or maybe venture out into different factors, or are you going to stick only with the DIY momentum?
I think for now I haven't looked very thoroughly in on other factors. The Probably the only factor that I could venture out to in the future, maybe with a larger corpus size, is low vol.
Okay.
Except low volatility, I don't think I would be adding other factors. Not quality, not value for sure. Value some. Somehow the way value is defined, like marquee value investors have been doing differently, right?
Right.
They are not objectively defining something as a value stock,
Hmm.
right? They look at it on a case by case basis, right? What value as a factor is trying to do is objectively to take that discussion completely out, because every factor investing you have to objectively define something, right? You have to have some metrics and some number behind that metric, right? To guide your decision on whether this qualifies or not, right? So that the way that value is constructed, I don't think it's working as well in the Indian market. So for
Right.
now, at least I'm going to stick with momentum only, and if I expand, maybe low volatility. In terms of strategy evolution, not a lot. I actually do not want to evolve it a lot. It will be fairly consistent, because I do not want to first complicate it. Yeah, wherever I think that something is adding a value, a material value to the performance or on the risk side, then I would do it. But otherwise not. What we have typically seen is like adding a lot of filters, a lot of these things, even like quality metrics and all, they usually
Hmm.
degrade the performance.
Right.
uh, the best is probably very very simple strategies,
Got it.
and the more important thing is discipline and time. Yeah.
Got it. And if let's say I were to flip the question, and if you were to remove certain filters and make it even simpler, what filters you might remove?
So right now I use above 200 DMA. I wouldn't remove that. last year returns more than the repo rate, probably I could remove that.
Okay.
Liquidity filters also I wouldn't tinker with. Circuits filter I might remove because many of these filters actually have limited advantage, and many of these filters actually have advantage, right? Also, like the 25% from all-time high, there is a case to test it, whether it actually like always works or not, because some people who got Zomato when it was down, right? It was not 25% from the all-time high, but the momentum effect started from way back then. But for me, if I have that condition, I would wait till Zomato comes till that condition, and then I would buy it, right?
Yes.
So there are some constraints like that, but overall, I haven't thought of like removing any filter. There are anyway like 3-4 filters only for my strategy.
Great. I think if you overfit, then we might be hampering it too much, and let it be simple. That's a great thing, Abhijit.
Yeah, and even whenever you are like overfitting and practicing, you are doing it on a certain like maybe a decade of data or 2 decades of data, right? What's the guarantee that like something like that works
Yeah,
in the next 10 years? That's also a concern.
keeping it simple is the best policy.
Yeah, for now it is. Yeah.
Good. So let's say if you were to help an upcoming DIY investor now, what would be your recommendations be? It can be in terms of the resources that they can read, or it can be in terms of the behavioral changes that they would want to do. What would be the 3 advices that you want to give?
Got it. I myself, I consider myself like a beginner and a fool when it comes to momentum investing or investing in general. So I'm not sure if I'm qualified enough to advise anyone, but probably my first advice would be to not take advice from anyone. Yeah, matlab, don't listen to anyone. Look at the data first. Okay, like look at well researched data. Look at reports. Look at what people are talking about. Expose yourself to like mindsets and thought processes, and then you get to the intricacies of that, right? And one broad thing I would say. Before getting onto resources and all is to never lose sight of the forest for the trees, as they say, right? We get so much hung up on some like something giving like 0.2% here or there, so much tinkering that keeps happening. We lose sight of the bigger picture. So your bigger picture is not you getting the most optimal returns possible. It is probably getting what works best for you. Your aim is to grow your corpus, right? So be focused on that. You need to understand yourself, and discipline and time are very much more important than the 0.05% that you would optimize after like doing maybe 30 hours of research, right? So always think in terms of long-term investing. Always look at your investing journey in terms of decades. Never look at your portfolio in terms of stocks. I mean, look at it in terms of the whole portfolio. Whenever you are talking to someone, whenever you are consuming content, also never look at what one stock is doing.
Right.
Because if you buy
Yeah.
100 stocks, one stock can do anything, right? One stock can go to zero, one stock can become a 10 bagger also. Doesn't matter. Did you at a portfolio level reach somewhere or not? Because that is what will create your wealth in the long term. So that's something that you should keep in mind. In terms of resources, so there are a lot of resources. Books like Stocks on the Move by Eflino, or you can read books from Wes Gray. You can read a lot of articles are there on Alpha Architect, actually, if you're not aware. So you can check out those blogs. Some of the essays are in papers authored by Mr. Rajan Raju. You can look at them. Those give you the context of Indian equities market rather than many of these research papers. The original, if you go to the original Jagdish statement research paper, all of those have been like in the US context, right? So
Right.
and apart from that, there are multiple talks and podcasts on YouTube. Stoic Talks is what I used to follow, and like I'm still there are like some wonderful interviews on that podcast. Some of the Capital Mind and Mystic Wealth blogs on Medium also, right?
Right.
So whatever you find, just expose yourself to different thought processes. Twitter, YouTube, whatever, and see whether these things are making a difference and how you're going to apply it. If you're not going to apply it, if something is just like a food for thought thing or an experimentation, you can just get an exposure and move on. Right? Not everything has to go and impact your strategy. So be very very careful about what you are letting to trickle down to your strategy. Consume everything, look at everything, but just see how much it moves the needle.
Great. So, Abhijit, if anyone wants to reach out to you, what are your digital handles?
Yeah, so they can reach out to me at InvestingFool at Twitter. They can reach out to me on email as well, investingfool25@gmail.com. And they can on the YouTube channel, they can just comment anywhere and I will reach out to them.
Great. Thanks a lot, Abhijit. It was a really great discussion. I hope our viewers also would enjoy this discussion. Looking forward to meeting you again.
Thanks, Shikhar, for having me, and thanks everyone for watching. Whoever you have, if you have been watching till now, we are also we are also fairly recent into momentum investing, and I just hope that we all continue to learn and grow together. That's always the purpose.
Yeah, same here. Enjoy. Bye, guys.
Thank you.